Welcome back to the Daily Economy 24/7. Every time you tune in, you're joining a community of people who want to understand the world a little deeper, think a little clearer, and stay grounded no matter what the headlines say. Today's episode takes us into a tougher chapter, a look at the recession unfolding in 2026 and the forces that brought us here. But you're not walking through it alone. We break it down together, piece by piece, so you can navigate the uncertainty with clarity and confidence. If you're new to the channel, welcome. Settle in, you're in good company. And if you've been with us for a while, thank you for being part of this growing family. Your support, your comments, your engagement, it all helps shape the conversations we have here. Let's dive into today's episode. 2026 was supposed to be the year the economy found its balance again, the year inflation cooled, the labor market normalized, and the turbulence of the early decade finally faded. But instead, the year opens with a different story. A darker one. A story of an economy that didn't just slow, it slipped. Quietly at first, then suddenly. And by the time policymakers acknowledged what was happening, the country had already crossed the threshold into recession. The warning signs were there long before the headlines caught up. Consumer spending, the engine of the American economy, began to weaken in late 2025. Households were still spending, but the pattern had changed. Essentials replaced discretionary purchases. Savings rates ticked up. Credit card balances stopped rising. It wasn't panic, it was caution. A subtle tightening of the belt that signaled something deeper: fatigue. Businesses felt it too. Orders slowed, inventories piled up, hiring plans were paused. And then, in sector after sector, layoffs began to spread, not in massive waves, but in steady, persistent cuts that chipped away at confidence. Companies blamed restructuring, efficiency, and market conditions, but the truth was simpler. Demand was weakening, and margins were shrinking. By early 2026, the labor market, once the strongest pillar of the economy, began to crack. Job openings fell sharply, hiring slowed to a crawl, and unemployment, which had hovered near historic lows for years, began to climb. Not dramatically, but consistently, month after month, the kind of rise that economists recognize instantly, the early slope of a recession curve. At the same time, the Federal Reserve found itself trapped. Inflation had cooled, but not enough to justify aggressive rate cuts. And yet the economy was weakening faster than expected. It was the worst possible combination. A moment where monetary policy had limited room to maneuver, even as the economy cried out for relief. The recession didn't announce itself with a crash. It arrived like a slow leak, a gradual loss of pressure, a quiet erosion of momentum. And by the time the data confirmed what millions of households already felt, the downturn was fully underway. This is the story of 2026, not a soft landing, but a hard truth. A year where the economy didn't rebalance, it broke. A year where the forces shaping the decade, automation, inflation fatigue, geopolitical tension, and structural labor shifts, converged into a single, unavoidable outcome. A recession that wasn't caused by one thing, but by everything. And the deeper story is just beginning. The recession of 2026 doesn't hit like a hammer, it spreads like a shadow. Slowly at first, then all at once. And the first place that shadow falls is the labor market. Morgan Stanley warned that the U.S. would enter 2026 with weaker growth and more labor market slack, even before the downturn fully materialized. That slack becomes unmistakable by the first quarter. Job openings fall sharply, hiring freezes spread across industries that had been aggressively expanding just a year earlier. Wage growth slows, and unemployment begins its steady climb, not a spike, but a slope. The kind of slope that economists recognize instantly as the early curve of a recession. The St. Louis Fed noted that economic and political uncertainty dominated 2025, with delayed data releases and volatile conditions clouding policymakers' judgment. That uncertainty carries into 2026 like a fog. Businesses can't see clearly, households can't plan confidently, and policymakers are reacting to data that arrives late, incomplete, or distorted by the government shutdown that disrupted key releases in late 2025. This fog becomes the perfect environment for a recession to take root. The labor market breaks its illusion of strength. For years, the labor market had been the strongest pillar of the U.S. economy. But in 2026, that pillar begins to crack. Not because of a single shock, but because of accumulated pressure. Companies that overhired in 2021 to 2023 begin trimming staff. Firms that delayed layoffs during the inflation surge finally pull the trigger. Automation investments made in 2024-2025 begin replacing roles. Wage pressures ease as workers lose bargaining power. Rosam's 2026 outlook expected slower wage growth and persistent affordability concerns even in a stable scenario. In a recession scenario, those pressures intensify. Workers feel squeezed from both sides, rising unemployment and rising living costs. Inflation is cooling, but prices remain elevated. Rent is still high, groceries are still expensive, healthcare is still unaffordable, and wage growth no longer keeps up. The emotional landscape shifts. Confidence erodes. Households retreat. The consumer pullback begins. Consumer spending, the engine of the American economy, begins to sputter. Not collapse. Sputter. Households don't stop spending, but they change how they spend. Essentials replace discretionary purchases. Big-ticket items are postponed. Travel slows. Dining out declines. Credit card balances flatten as households tighten budgets. Oxford Economics had projected that high-income spending and AI-driven investment would keep the economy afloat in 2026. But in a recession scenario, even high-income households become cautious. Wealth effects weaken, stock market volatility reduces confidence, and the top 20%, who drive nearly 40% of all consumption, begin to pull back. When the top slows down, the middle freezes, and the bottom struggles, the entire economy loses momentum. Business confidence collapses. The business sector enters 2026 already bruised. Tariffs, policy uncertainty, and the government shutdown of 2025 left scars. Markets.com noted that these shocks dampened growth and clouded policymakers' judgment. By early 2026, business confidence breaks. Orders decline. Capital expenditures are delayed. Hiring freezes become layoffs. Expansion plans are shelved. Startups struggle to raise capital. Small businesses face tightening credit. The credit cycle tightens as banks become more cautious. Lending standards rise. Interest rates fall too slowly to provide relief. And businesses that were barely hanging on in 2025 begin to fold. By mid-2026, the recession is no longer a whisper, it's a headline. GDP contracts. Unemployment rises. Consumer sentiment hits multi-year lows. Business investment falls. Housing activity slows. Defaults begin to tick upward. The downturn is not catastrophic, but it is grinding. A slow, persistent erosion of economic vitality. And the emotional toll is heavy. Workers feel uncertain. Businesses feel exposed. Policymakers feel cornered. Communities feel anxious. This is the anatomy of the 2026 recession, a downturn born not from a single crisis, but from the cumulative weight of structural pressures, policy missteps, and economic fatigue. And the story is far from over. The recession of 2026 is not a dramatic collapse, it is a grinding contraction. A slow tightening of the economic arteries. A year where the country doesn't fall off a cliff, but sinks into the mud. And the deeper you look, the more you see that this downturn is not a temporary detour, it is a turning point. To understand where the economy goes from here, we have to begin with the risks that deepen the recession, the structural forces that prolong it, and the long-term consequences that shape the decade ahead. Morgan Stanley warned that the U.S. would enter 2026 with weaker growth and more labor market slack, even before the recession fully materialized. But the real danger is the policy fog that carried over from 2025, tariff aftershocks. A government shutdown that delayed key data releases. Confusion around inflation readings. A Fed forced to operate with incomplete information. The St. Louis Fed noted that economic and political uncertainty dominated 2025, and that uncertainty bleeds into 2026 like a slow poison. When policymakers can't see clearly, they can't act decisively. And when they can't act decisively, recessions last longer. Rosem's 2026 outlook expected slower wage growth and persistent affordability concerns even in a stable scenario. In a recession scenario, those pressures intensify, job openings fall. Hiring freezes spread. Wage growth stalls. Layoffs accelerate. Workers lose bargaining power. Underemployment rises. This is not a labor market correction, it's a labor market reset. The illusion of strength breaks. The cracks widen. And the recession deepens. Consumers are the backbone of the U.S. economy. But in 2026, that backbone bends. Households face high prices, slowing wage growth, rising unemployment, tightening credit, volatile markets. Oxford Economics warned that the economy's strength in 2025 was heavily dependent on high-income spending and AI-driven investment. But in a recession, even high-income households pull back. When the top slows down, the middle freezes, and the bottom struggles, the entire economy loses momentum. Markets.com's 2026 scenarios warned that a shallow recession was increasingly plausible, driven by tariff aftershocks and policy uncertainty. In a recession scenario, capital expenditures are delayed. AI investments slow. Hiring freezes become layoffs. Expansion plans are shelved. Startups struggle to raise capital. Small businesses face tightening credit. The business sector becomes defensive, and when businesses retreat, recessions deepen. This recession is not just cyclical, it is structural. Even as the economy contracts, companies continue investing in automation. Not because they want to, but because they have to. AI becomes the lifeboat. Efficiency becomes the survival strategy. And workers become the cost to cut. This accelerates job displacement, department consolidation, productivity without hiring, a widening skills gap. The recession becomes a catalyst for the next wave of automation. Recessions always hit the bottom hardest. But this one hits differently. High-income households tighten spending. Middle-income households freeze. Low-income households fall behind. Affordability pressures, already severe, become crushing. RSM warned that inflation will stay above 2% and affordability concerns will persist even in a stable scenario. In a recession, those concerns become crises. Some regions weather the storm. Others drown in it. Tech hubs slow but survive. Industrial regions weaken. Rural areas face deeper job losses. Housing markets in overheated cities cool sharply, migration patterns shift again. The recession exposes the unevenness of the American economy. Every recession has an ending. But not every recession has a clean one. 2026 ends with a weaker labor market, slower wage growth, persistent inflation pressures, a cautious consumer, a defensive business sector, a Fed still navigating uncertainty. But it also ends with the seeds of the next expansion. Morgan Stanley expects inflation to moderate meaningfully by mid-2026 as tariff effects fade. This gives the Fed room to cut rates, slowly at first, then more confidently. Rate cuts don't end recessions instantly, but they begin the healing. Investments made in 2024-2025 begin to pay off. Automation boosts output. Efficiency improves. Costs fall. This becomes the backbone of the next expansion. Once inflation cools and wages stabilize, households regain confidence. Spending returns, cautiously at first, then steadily. The recession ends the same way it began, quietly. 2026 is not the year the economy rebalanced. It is the year the floor gave way. A recession born not from a single shock, but from the cumulative weight of policy uncertainty. Labor market fatigue. Consumer retreat. Business caution. Structural automation. Global fragmentation. But recessions are not endings. They are transitions. And the story of what comes next, the rebuilding, the rebalancing, the redefining, begins the moment the downturn ends. Thank you for spending this time with me today. I know this episode was heavier than usual, but understanding moments like this, the tough ones, is what makes our community stronger and more prepared. If this breakdown helped you see the bigger picture, I'd love for you to stay connected. Follow the channel, share this episode with someone who needs clarity, and jump into the comments to tell me what stood out to you. Your voice matters here. Your perspective helps guide where we go next. This isn't just a podcast, it's a community built on curiosity, honesty, and real conversation. So stay engaged, stay informed, and stay with us as we continue to navigate the story of the economy, one chapter at a time. This is the Daily Economy 24/7, and we're just getting started.